Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Oil prices are on the rise again, up about 3.6 right now after conflicting statements from U.S. and Iranian officials reduced hopes for progress on ending the war. U.S. President Donald Trump is urging Iran to get serious about negotiations or face the consequences. Officials in Iran say they have no intentions of having talks with the U.S. Shares of BRP are trading higher today, up about 4% after the maker of Skidoo and recreational vehicles reported revenue and profit in its latest quarter that beat expectations. Revenue jumped 17% compared to the year before. BRP also boosted its dividend and delivered a 2027 revenue outlook that came in above estimates. And we will get a closer look at BRP's results and outlook when we speak with CEO Denis Levaux later today on Trading Day. Rio Tinto has shut down its last diamond mine, ending more than 50 years in the diamond business. For the world's second largest miner, the company confirms that the Diavik mine in the Northwest Territories has produced its final batch of stones. The closure marks Rio Tinto's complete exit from diamonds as it shifts focus to its core commodities, including iron ore, copper, and aluminum. And taking a look at the markets, even with oil pushing upward. Oh, actually, TSX just has taken a flip. It was up last time I checked, and now that I look again, it's off by about 0.2%. That's the way the markets are going right now. South of the border, similar situation. They are off right now. The S&P 500 down by 0.64, Dow by 0.16, and the NASDAQ off by nearly a point. Okay, since the Iran war started, oil is up more than 40%, and major North American indices are down more than 4%. Is the end of the war and high oil prices in sight, and is this the time to buy stocks? We have Eddie Gabor now, CEO of Key Advisors Wealth Management, here to help break it down for us. Eddie, thanks as always for joining us.
Thank you for having me.
We had a nice little run this week. Today it looks like it's turning. How are you approaching the way things are unfolding right now?
So we came into the year very bullish. We were very underweight technology. We didn't like technology, but we loved the economically sensitive areas because inflation was trending down and growth was trending up. And since the attacks, we have completely flipped the script, and we have been selling rallies. We have the least amount of stock exposure we've had since 2022 because we think we're heading into a global stagflationary environment, unfortunately. So we believe these markets are going to be extremely challenged over the next couple of months because we're going to see some significant increases, in our opinion, on the rate of change of inflation to the upside. And I think these markets and investors are way too complacent for what could possibly come down the road. So we think April is going to probably, in our opinion, be a very challenging month to the downside. So we've raised a significant amount of cash in the money markets. We're going to sit on the sidelines, stress-free, watch how things unfold. And we think we're going to be able to buy this market back much lower in the coming weeks ahead.
Now, do you see yourself moving even more into cash, or is this kind of where you're happy sitting?
You know, I don't think you can have enough right now. You know, trying to predict the bottom in this is impossible because until the Straits of Hormuz is open and oil is flowing like normal, it doesn't matter what the narrative is. The market's going to continue to trend down, in our opinion, because this energy shock is devastating for many economies around the world, and we are a global economy. So we probably won't go to 100% cash, but we probably won't be any more than 20% invested in equities. And that's a significant takedown in risk. But we don't believe these markets are a buy and hold market. You've got to be tactical, in our opinion, because if you want to take advantage of drops, you have to position yourself accordingly to be able to do that. And I think the buy and hold strategy is one that's going to be painful here.
And do you feel that even if this were to end in the next couple of weeks, the repercussions and fallout may linger a lot longer than people are expecting?
We do think that. I mean, the damage is already done in the near term. You can't have energy spike by 40% and expect it to come right back down. We think it's going to be a while before oil even comes close to being in the 60s. And even if there's an agreement this weekend, which we hope and pray happens, the inflationary pressures that we're going to feel are going to be here for the next 2 quarters at a minimum, because you can't just snap your finger and have the oil flow and other commodities flow like they were pre-attack. So I think people are really underestimating the impact of this energy shock. And we're going to start to see a slowdown of economic data in the coming months ahead. And then in April, I think the CPI data is going to cause some eyes to really pop, because we're going to see a big increase based on how we're viewing things.
And you mentioned stagflation with that. When do you think, and how long do you think that might last?
So normally you're going to get the inflation first, and the bond market is screaming that, hey, inflation's going much higher. The 10-year has gone from 4 to 4.4 in a very short period of time. So I believe by the time we're going into the mid-second quarter, which we are approaching, that we're going to start to see the economic data show some slowing. We already were showing some slowing pre-attacks. And now this is just going to accelerate that. So we're going to get the inflation first. Rates are going to go higher, in our opinion. And then you're going to start to see the downtrend. And that's when you're going to start to really see selling more than likely accelerate on the equity markets, because I'm shocked that the markets are only down about 4% on a year-to-date basis right now. Based on how we're seeing things, we're going to be down double digits before we can even consider buying back in.
All right, and we're going to talk about the buyback in a sec, but you're also into gold, and it's been quite volatile, I think more so than some people expected since this started, but you say you're still looking at gold.
We are. Now, yesterday what we did, because we grossed up our position during the sell-off, gold had 10 straight down days. I think that's the longest streak in history. So what we did is we were buying that dip in gold, expecting a little bit of a bounce back. We sold a third of our gold position yesterday. It had a big move up. We wanted to take some more and increase cash more, because cash is king right now. But we're going to continue to stay long gold. But gold is going to be challenged over the next month until rates and the dollar stabilize. So we will probably gross our gold position back up sometime in May, because by then I think it's going to be clear we're in a stagflationary environment, and gold should be one of the biggest winners in that area. So we won't get completely out, but we have reduced our positions to give us dry powder to buy more in the coming weeks ahead.
And now you mentioned there'll be some great buying opportunities maybe late in the second or even beyond, depending, of course, how everything unfolds. Any particular area you'll be looking?
You know, it'll depend on where we are in the economic cycle, but we'll probably be buying the things that we sold. You know, technology has taken a beating and continues to take a beating. We think we're going to be able to buy some high-quality tech names much lower than where they are now. So technology is going to be an area of focus. And then we're going to be looking at industrials, small caps, and some economically sensitive areas, because when you have a war, a lot of times after the dust settles, it's very good for economic activity because you have to rebuild things. So we're going to be in those areas as we go ahead. But again, we're not close to a bottom right now, but there are going to be some fantastic opportunities. And we think the setup, if you play it right, will be a year-end rally to new highs. So it could look a lot like last year from a market perspective.
All right, we have to wrap it up there. But Eddie, thanks as always for joining us.
Thank you for having me.
Eddie Gabor is CEO of Key Advisors Wealth Management. Coming up, we're talking to Mark Davies, CEO of Metatek Group, on its recent close of its IPO. That's after the break. Metatek officially closed its IPO. It aimed to raise $50 million, but ended up at $40 million at about $5 a share as it begins trading on the TSX. The company says the timing aligns with surging global demand in the energy sector. Here to talk further about it is Mark Davies, the CEO of Metatek. And Mark, thank you very much for joining us. Congratulations on
thank you.
Joining the TSX. Let's talk about that first. You were hoping for $50 million, ended up at about $45 million, $5 a share. Your thoughts on that?
Yeah, I mean, we wanted to go with slightly higher, but obviously with the geopolitics at the moment, we scaled back a little bit. Still raised the capital we needed to deploy for the growth of the business. It was just the secondary that was palm back a bit.
And where's the capital going to be going with that?
So it's all about instrumentation for us. So we have a huge backlog at the moment, north of 65 million USD, and we need to get through that backlog. So it's all about deploying instrumentation. So each instrument that we deploy, and that's what the capital is for, it adds 25 million onto our annual revenue.
Each machine?
Correct, yeah.
So they're not a little handheld GPS then?
No, they're not. These things are about the size of a US domestic fridge, go into an aircraft with a whole bunch of other instrumentation as well. So pretty big.
And where are they off to right now? Where's your backlog?
So most of our backlog is in Africa and Southeast Asia. That's where we've been deploying them for the last 4 years or so. We hope with the raising of the capital, we'll have more instruments to fetch across to North America and South America, where we already have clients waiting to get time on the instruments.
They have clients in South America and North America too,
Correct,
or just South America?
Yeah, no, North America and South America waiting for time on the instrument. Instruments are fully booked for the next 2 years. So.
And where do you hope to grow North America with that, or is it really you're just kind of playing catch up right now? You're so busy.
Yeah, it's all about catch up. We found that we were geographically our first projects were in Africa, and since then, because of the demand on the instrumentation, we've not been able to fetch it back across to North America. So hence why we've come to the market now to raise the capital to order these instruments.
And are you hoping to bring in more money in different ways over the next little while?
Well, at the moment, we focused on the short term, which is all about deploying these instruments. These instruments are pretty incredible instruments that are manufactured by Lockheed Martin. So it's about deploying that, and then we look at other possibilities further on down the line.
All right, and with these, you were running, if I'm not mistaken, you were in the negative. Did I get that correct? You're running you lost some money, but how are things going?
Yeah, we're still in the phase where we want to get the message out to the market, right? We're very new at the moment. And as we become more operationally efficient, get through that backlog, I think the market will track that success.
And with Canada has had a dearth of IPOs, I think people would question why come to Canada? Why Canada? Why not try to go to the U.S.?
No, it was always going to be Canada for us. So the knowledge base suits what we do. We're all about natural resources and we're all about technology. So the knowledge is there. So really speaking, it was either Canada or it was Australia, very similar. And geographically, the proximity made it Canada.
With Canada, with the U.S. and South America, does Canada still have that reputation? I mean, it was a mining country and natural resources. Does it, and the skill sets were there? Do you feel that still?
100%. Geopolitics is driving, resource strategy for all the nation-state customers that we have, and of course Canada has a wealth of natural resources. So I think that's going to pick up long term.
Now, I mean, I know Africa's your big. Do you see more opportunities in North America, or does it continue to be Africa?
No, I see big opportunities in North America. If you look at things like battery minerals, critical minerals, also oil and gas as well, that's come back into vogue over the last couple of years. And
what's it like for you dealing? I mean, it's I guess a different situation trying to. Do you have to worry about government and regulations, or is it kind of taken care of by the companies you work with? And
No, we have to. The equipment that we deploy is dual-use technology, so we're highly regulated. So, we have our own compliancy that we've got to check all the boxes, but also our clients as well, and the nation-states clients, they have their own compliancy as well.
And are you finding it easier to work here or other places, North America or other places?
I think it's a mixed bag. It depends on what nation state we are working with. The big difference when you're working with a nation state is that it takes a little longer for them to make the decisions. But once you make the decisions, they're there for the long haul. It's all about identifying natural resources within their subsurface. So it's something that we've seen over the last 3 years where there's been a pivot that nation states are taking care of understanding their subsurface.
Anyway, I should probably. What exactly does the equipment do? We talked about it, but what exactly does it do within the realm?
So we operate in all the terrestrial environments, but by far and above the biggest part of revenue is in the airborne environment. So we deploy these aircraft with lots of different instrumentation. But at the center of it, the jewel in our crown, if you like, is something called an FTG, bit of a mouthful, right?
But that's the short form. So
that's the short form. Yeah, full tensor gradiometer. And it's all about identifying minute changes in density within the subsurface. So if you think of Google Maps of the subsurface, that's what we're able to do. And at each interval, we're looking at the wealth and quantifying that for our clients.
And propriety, is that propriety? Is there any competition for you?
Yeah, there is some competition, but we fly the high end of it. We have exclusive global use for the high-end instrumentation. But exclusivity doesn't just come from those instruments that are manufactured by Lockheed Martin. It also comes from the cerebral know-how. You know, we know how to take it, put it into an aircraft, understand the data, interpret it, and deliver the product. So it's, you know, knowledge transfer in that way.
And when it's looking, is there certain minerals or that it finds better than others?
No, for us, it's one scan does everything. That's why it's in such demand at the moment. So we're all about, you know, identifying wealth, and by wealth I mean oil, gas, battery minerals, critical minerals, even new age stuff like hydrogen, helium, and geothermal. So one pass, one scan does all for our clients.
And when do you have any deployed in Canada yet, or
no? We don't. We do have projects that we will come back to do in Canada, but we've got to get through this huge backlog we've got at the moment.
And when do you hope to be in Canada with them, actually using them?
Probably be looking at the back end of 2027.
2027.
Yeah.
Okay, awesome. Thank you very much for joining us. We appreciate it.
My pleasure.
Cheers. And that was Mark Davies, CEO of the Metatek Group. And coming up, today's market drivers with Bloomberg's Monique Molima. We'll see why Nutrien shares are slipping today.
Tomorrow, from hating cops in his homeland
I've seen my father getting stopped by police officers all the time.
to becoming one in his new home.
To serve and protect.
How this moment changed everything.
I saw myself in the eyes of those children.
Tomorrow on CTV National News and watch on Crave.
Time to take a look at today's market movers. We are joined by Bloomberg Equities reporter Monique Molima. Monique, thanks as always for joining us. And we're talking a little bit of steel and metal today. We're going all iron. Nucor up first.
Yes, so Nucor, their shares are trading higher this morning after they were upgraded at UBS. Their shares have been under a lot of pressure recently on concerns related to demand because of the Iran war. But analysts say that this sell-off that's happened may have been excessive. They think there's actually going to be rising demand for U.S. steel on a lot of factors unrelated to the war. They note that the U.S. border wall has a number of contracts in place for American-made steel, and Nucor could benefit from this. There's a number of projects under the U.S. government's tax bill that also will require U.S. steel. And they also note that the Section 232 tariffs in the U.S., these were the ones that weren't related to the ones that were struck down by the Supreme Court. So the steel tariffs are still in place, which means it's more expensive to import steel into the U.S. So domestic producers like Nucor are expected to benefit. And while they are seeing a bit of impacts from rising energy costs due to the higher oil prices, a lot of their energy was hedged. So they're actually not seeing the brunt of the impacts of the war, and they're expected to see some upside in the year ahead.
All right, Nutrien getting a downgrade from UBS.
Yes, so Nutrien today was cut to sell at UBS, and its shares are trading lower. The stock has seen gains related to supply constraints because a lot of fertilizer comes from the Middle East or is transported through the Middle East. So because of the war, that hasn't been able to happen. So there's been more demand for North American fertilizer like Nutrien. But analysts at UBS note that Nutrien's also seen its own impacts from the war. Input costs are going to be higher because of some of the materials that they need to use. And they also think that some of this upside that's been priced into the shares might not last. If the disruption isn't as long as people think, they could see a pullback in shares and in fertilizer prices, which they think could happen as soon as the second quarter. And they also note for Nutrien that looking out more long-term for the company, there is expected to be more pressures in potash through this decade. So even though in the near term they've been seeing the upside from higher prices, long term that's not expected to last, which is why they've downgraded the firm.
All right, and commercial revenues, Q2 revenue slightly beating commercial revenue. Commercial metals, I'm looking at the question combining. Commercial metals, is that the one we're talking about? Slight beat on rev?
Yes, so Commercial Metals, they're a steel company, and they did beat on revenue, but they missed on earnings per share for the quarter. They saw some strength in some of their industrial segments and some of their North American steel, but they are expected to face some pressures going into the next quarter, which is why we've seen some of the share price declines today. Analysts know that the company's North American steel segment is going to have some factors like the annual maintenance that's going to impact some of their earnings. And also the company is facing some of the impacts from the war as well. They get a lot of their energy from Europe, and those prices, as we've seen with oil prices, have been rising. So because of that, they're going to have higher costs going into their next quarter of reporting. And that's part of why we're seeing this pressure, where even though they beat on some metrics today, the next quarter is going to have some of these other factors weighing on it.
All right. Last up, Mara Holdings having a bit of a sale.
Yes, so Mara Holdings, their shares are higher today. They are a Bitcoin miner and data center operator, and they announced that they sold $1.1 billion worth of Bitcoin. This was over 15,000 tokens, and this is quite a large sale for this company. In addition to mining Bitcoin, they also hold Bitcoin on their balance sheet. But they sold this to be able to buy back some of their senior convertible notes. They say this is going to help deleverage the company and reduce some of the overhang. And the Bitcoin miners also focused right now on transitioning to AI and high performance computing. This is an area that they're seeing a lot of growth right now with tech companies needing power for their AI. And the company said that this is going to help them also kind of shift that focus with selling out a lot of their Bitcoin to now move into this new area that's seeing more growth as crypto's seeing a bit of a decline.
Okay. Monique, thanks as always for joining us. Bloomberg's Monique Molima. Up next, Rio Tinto shuts down its last mine, marking an end to more than 50 years in the diamond business. We'll break it down for you after the break. Look at that. Oil prices up again, about 4%, a little more than 4%. All this after conflicting statements from Iranian and U.S. officials reduced hopes for progress on ending the war in the Middle East. U.S. President Donald Trump is urging Iran to get serious about negotiations or face the consequences. Officials in Iran say they have no intention of talking with the U.S. The CEO of Air Canada has apologized for his English-only condolences video following the fatal crash at LaGuardia Airport. Michael Rousseau says despite many lessons over several years, he is still unable to express himself adequately in French. He added that he is saddened that his inability to speak French has shifted attention away from the grief of the families. The apology comes after Prime Minister Mark Carney called the lack of a French statement disappointing. Shares of Olaplex are seeing a surge, a bit of an understatement. It's up 51% right now to $2 even. It's the maker of industrial and consumer chemical products. Henkel has agreed to buy the premium hair care brand for $1.4 billion US. Henkel will pay $2.06 per share. Olaplex went public in 2021 and has faced a few headwinds since the company's revenue growth has slowed in recent years, with shares sinking from a high of nearly $30. And taking a look at the markets, they had a mix of green earlier today, but right now the TSX has done a quick spin and gone the opposite way. It's down about 0.2% right now. And south of the border, U.S. markets, no different. Kind of mixed. Everybody's trying to figure out their footing on this one. S&P 500 off by 0.78, the Dow by about a third, and the Nasdaq is off by more than 1.1. Well, Rio Tinto has shut down its last diamond mine, marking an end to the more than 50 years in the diamond business for the world's second largest miner. The closure marks a complete exit from diamonds as the company shifts its focus to core commodities. Let's get more perspective now from Rick Rule, President and CEO of Rule Investment Media. Rick, thanks as always for joining us.
A pleasure. Thank you for having me back.
Okay, is this a big deal or is this just something that was coming?
I think something that was coming. The diamond segment is fairly small. Rio Tinto had spent some money in Canadian exploration without much success. There's increasing pressure in the diamond market from synthetic diamonds, and it's fairly apparent that the structure of the diamond industry itself is changing, with De Beers mulling a sale to either Botswana or Angola, or a combination of Botswana and Angola. Rio Tinto was not a force in diamonds, and the diamond business itself isn't a business that has the sort of scope and scale that, say, Rio's aluminum business or their copper business or their iron business has.
Do you see anybody kind of picking up the slack here in Canada for that closure, or are we kind of following the rest of the world when it comes to diamonds?
It would appear that in terms of exploration and in terms of, if you will, cost per carat, that Canada is relatively inefficient, as is, by the way, Australia, compared to the African producers. One, discovery could change that, but diamond exploration in Canada has been fairly limited for the past decade. It's tough to find something without exploring for it. And one wonders, given the size of the diamond market and the projection of diamond market growth relative to the growth that would appear to be built into, as an example, the copper market, that Canadian exploration for diamonds will continue to be limited. And as a consequence of that, the probability of exploration success, I think, is fairly low.
So diamond mines are no longer diamond mines.
I think that's right.
Okay, now Rio Tinto then. So where does it go now? What's it doing?
Well, Rio has a real challenge in front of itself and a real opportunity in expanding their copper business. Demand for copper continues to grow given worldwide electrification, but also as a consequence of 30 years of underinvestment in copper. Rio, as have the other big mining companies, identified copper as a real sort of a growth track. Meanwhile, they need to maintain their iron business. They are part of the new Simandou mine in West Africa, and they continue to be a dominant player in iron through the Pilbara. So I think the future of Rio is in the major industrial material markets, which is to say iron, copper, and for them, aluminum.
Now, we've seen copper, though, the last little while, it's dropped. Is there any concern of that, or is that more of a blip?
I think that's a real blip. I think copper markets are reacting to the probability of an economic slowdown, global economic slowdown, as a consequence of the Gulf conflict. Longer term, however, we have been underinvesting in copper for 30 years. The writing is on the wall there.
And so, but these aren't easy. I mean, it's 10 years, right, to get a copper mine up and running, essentially?
I think that's an optimistic estimate, frankly. My hope is that the regulatory environment around that changes as copper prices rise and as the need for copper in terms of the electrification of the world becomes more apparent. Much of the discussion that we hear around copper involves things like data centers and electric vehicles. But the truth is there's 1 billion people on Earth, poor people, with no access to primary electricity. If humankind is going to do its job, raising the living standards of the poorest of the poor, we start with energy density, and that goes right straight to copper. My hope is that governments around the world understand the humanitarian imperative of increasing world copper supplies, and as a consequence of that, lowering the real cost of electricity to 1 billion poor people globally.
Now, like copper, silver is needed. Do you see it kind of following copper then for demand-wise?
Yes, but I think I would argue it's less essential. The other thing about silver is it's very tough to boost supply from silver mines because most silver in the world is produced as a byproduct of other materials. So trying to impact supply in silver by exploring for silver itself is an elliptical path at best. Mercifully, a lot of silver is produced as a byproduct from copper mines. And I would suggest that the easiest way, although it's elliptical, to increase silver supplies is to increase their supply as a byproduct of copper mines. The recent streaming agreement between the largest mining company in the world, BHP, and the Canadian firm Wheaton Precious Metals, the $4 billion transaction is a real validation of the theme that silver supply really is a consequence of byproduct production from other metals like copper, lead, zinc, and gold.
All right, and then let's end with gold, and where do you see it going? Where are we sitting with that?
I think in the very near term, gold is challenged. What you're seeing right now is a consequence probably of the Gulf crisis, is a flight to what the market regards as a safe haven, which is to say the U.S. dollar. The DXY is on fire. Also, you're seeing market-driven higher U.S. interest rates, which makes the U.S. dollar relatively attractive to other currencies and makes gold less attractive. The longer-term outcome with regards to, I think, the Gulf War will be a period of economic stagnation. The U.S. government's response to that has always been quantitative easing, which, by the way, if you did it, would be called counterfeiting, and also artificially lower interest rates, which will, I think, in the out years, reduce the real purchasing power of the U.S. dollar, and as a consequence of that, increase the nominal price of gold, which is to say the U.S. dollar price of gold. I see this near-term decline in the gold price as a real opportunity for people who understand the value of gold relative to fiat-denominated currency instruments, particularly U.S. dollar-denominated instruments.
All right, we'll wrap it up there, Rick, but thanks as always for joining us.
Thank you for the opportunity.
Rick Rule is president and CEO of Rule Investment Media. Coming up, Micron shares are under pressure after Google unveiled a technology that could reduce memory chip usage. We'll speak to an analyst after this. Micron is the largest American maker of memory chips, and its shares are under pressure for a second day off by about 4.5% right now after Google unveiled technology that could lower the amount of memory needed in AI models. To help us make sense of all this, we're joined by Matt Bryson, analyst at Wedbush. And Matt, thanks as always for joining us. Where do we stand with this? Is this legitimate, or are people overreacting?
I think that Google improving the algorithms around using memory is legitimate. I don't think it changes how much memory gets used, though. So the things I'd point out are, one, if you're buying an AI chip, so say a B200 or a B300 product from NVIDIA, it comes with a set amount of HBM. So regardless of whether the memory is bottleneck or not, you're still getting, for the B200, 192 gigs of HBM. And so the number of chips is going to define how much memory you buy, not how efficiently you're using it. And then from a longer term perspective, so we'd have to be thinking out a couple of generations, the idea being that maybe if memory is being used more optimally, that NVIDIA isn't designing as much memory alongside chips. The history of memory is that everything becomes more memory intensive. And so we're always seeing optimizations. I don't think if we move out 3-4 years that you're going to see memory content per chip go down. And so from my perspective, in the near term, it just doesn't matter. And in the longer term, it probably doesn't matter.
All right. Just quick, I'm going to ask for the people who may not know what it is. Myself might be included in this. HBM is something memory, right?
Yeah, it's high bandwidth memory. It's the memory that gets attached to NVIDIA chips or TPUs. So it's the memory being used predominantly for AI.
Okay, and so where does Google fit in then with what they're doing? Where do you see that finding a place? As workloads shift towards inference, memory has become more and more of a bottleneck. And so over time, this potentially allows your whole AI board, if you will, to be more efficient. And so it's a good thing, right? One of the questions about AI is how expensive it is. If you're able to make it less expensive, get more performance per chip, it should hypothetically increase adoption over time because it's more efficient to use AI. All All right, and we're seeing the sell-off. I mean, looking at Micron is down after they had a great earnings report last week. Do you see people taking a second look at this and going, no, we need to relax?
No, I think it's just that everyone is always nervous when you have these cycles in silicon. So I don't think we're anywhere near the top of the memory cycle in the sense that I don't see this year or even next likely how you find a path to having enough DRAM or NAND supply. Having said that, we're at all-time historic highs in terms of margins, in terms of cash generation, and so I think during these periods, people are a bit quicker to choose to sell, just because. Again, there's a long way down during a down cycle, and so when you get news flow, it makes people nervous.
Is there a new direction these companies are looking for when it comes to memory, or is it just trying to cram more into the same space?
I mean, I think everyone's always trying to optimize. There have been, hypotheticals around new types of memory, but what we've seen for the history of memory is you had NAND come out and gain traction in the 2000s. Beyond that, there have been a bunch of different types of memory that have been introduced and just haven't gotten traction. So Intel's Optane is probably the best known, but you had things like ReRAM and the crossbar memory, and it's just really, really hard. And so I think people will try to use memory more optimally as it exists, but I think finding new types of memory, it's going to be a long process with uncertain success. Now,
Intel saying they hope to have this out later this year. Is that timeline realistic with everything that's unfolding?
It's not unrealistic that something comes out. I think it's unrealistic if you think there's going to be significant adoption in a relatively short time period. So what Intel showed with Optane is not necessarily that Optane was a terrible product. It certainly didn't quite live up to the hype that Intel had when it was first introduced. I want to say in like 2017, 2018. But the larger problem was shifting around all the infrastructure and software protocols to work with that memory, because the processor has to understand it's dealing with a different type of device. The software that you're running has to understand that the parameters of this memory are different. And so doing all that work is really hard and time consuming. And so I'm not necessarily saying that Intel won't hit their timelines, but adoption is something that will take years, just because this is really complex.
And then can we throw AI in all of this? And where do you see AI fitting in over the next year with speeding things up, improving memory? Is it at that point it's going to be used even more so?
I mean, I think that's what we're seeing, right? You're seeing agents kind of take over the conversation. So you had NVIDIA showing off OpenCloud GTC last week. There have been a ton of stories about how OpenCloud's getting substantial traction in China in particular. So that's agentic AI in the device. But I think from an inference perspective, for organizations, I mean, we're using it more and more in my workflow. You're certainly seeing it on the coding and software development side, that AI is becoming a bigger and bigger portion of the workflow there. And so I think that as you can get AI more efficient, it just continues to gain traction. And the last thing I'd point out is we've had 3 of the 4 largest tech companies in the U.S. come out and tell us that they're only spending more on AI. And so certainly they're seeing something of an inflection.
Okay, we'll wrap it up there. But Matt, thanks as always for joining us.
Thank you.
Matt Bryson, an analyst at Wedbush. Coming up, despite economic uncertainty and return to office mandates, Canadians' appetite for recreational real estate remains strong. We'll show you how strong after the break. Reeling from Trump's trade war and high borrowing costs, residential and commercial real estate in Canada are experiencing a significant slowdown. However, demand for recreational real estate remains strong. Now, why is that the case? And are there any opportunities for buyers? To unpack this, we have analysts Cugliere Allegretti, Vice President of Research and Communications at Royal LePage. And Annalise, thank you very much for joining us today.
My pleasure. Thank you so much for having me.
It is a bit of a surprise to see these numbers, knowing the way the housing market has gone. Yet we're seeing almost a surge in demand for recreational.
It's an interesting segment of the market. In some ways, it does mimic the residential market. You'll notice that we saw a little bit of a slowdown, some dip in the pricing in our most expensive markets, like waterfront, for example, in Ontario and BC, which was dragging down the national number. But by and large, activity last year was pretty much on par with the year before. And looking ahead, we do expect a continued demand in this market. And one of the reasons for that is that Canadians are more and more choosing to spend their travel dollars here in Canada. Research from Royal LePage from last year found that a large portion of Canadians who own property in the U.S., more than half of them plan to sell, and about a third of them said they were going to reinvest in Canadian recreational markets. So some of the demand is going to come from there, as well as those who would just typically travel to the U.S. We know that's been down month over month over month. Canadians traveling to the U.S. is down, and so they're choosing to spend their travel dollars renting in cottage country as well.
Do we know how many Canadians own property in the States?
Typically, it's around 1 million on any given year. And so last year, like I said, more than half of them said they were planning to sell, call it between 500,000 and 600,000, even if half of them really pull through with it. And this could translate to really tens of thousands of new entrants into Canadian recreational markets, which are chronically and historically very undersupplied. New development in recreational markets is very low compared to the residential market. And another factor that contributes to that is in a residential market, you'll find that most move-up buyers sell a property at the same time that they buy. So they're purchasing a property and they're also putting one back into the market. The cottage market doesn't always work that way. Sometimes a cottage or a chalet will outlive its owners and get passed on from generation to generation. So there's a real lack of supply that is always going to be constrained compared to the demand that's growing in those markets.
And the people who are buying, are they buying as investment property, or are they buying because they just want to go up to the cottage? Or the cabin, or I forget.
Or the cabin, I
forget. There's a couple other different names for different places. Yeah.
I think, Roger, we can all agree that spending summers by the lake, especially after the winter that we've had this year, is a pretty delicious dream. And I know that for most Canadians that are buying, they are hoping to enjoy it, even if not full time, at least part of the time. Even investors who are making some rental income off of their properties in markets where short-term rentals are not restricted, of course, they're doing so to offset the cost so that they can enjoy those properties themselves. It certainly doesn't see the same sort of investor activity as a condo market in a large urban center would.
I'm not sure if you can talk to it or not, but can you talk to some of the things that people should be aware of if they're thinking of this as an investment property?
Yeah, it's a very good question. There's so many regional nuances depending what market you're buying in. We know that in Muskoka, for example, there are rules against what periods of the year you can have short-term rentals in, or the minimum amount of the minimum length of a rental stay that has to be adhered to. It's a really good idea to just look at municipal laws. It would be impossible to go through sort of all the restrictions from coast to coast because they're so nuanced. But certainly a realtor in that market would be able to point all of those things out. But that's probably the biggest thing to consider if you're doing it as somewhat of an investment property.
All right, we've talked about how they're up. We talked about if you're looking at buying one. How much is it actually costing you? What's the highest area, the most expensive area, cheapest area if you're looking for one?
Yes, if you're looking, from a national perspective, again, similar trends to what's in the residential market. So waterfront properties in, the Okanagan Valley, in Muskoka, mostly in BC and Ontario, you're going to see the most expensive properties. There's definitely some more affordable cottage units in the province of Quebec and in Atlantic Canada for those that are willing to, possibly travel outside the province, depending where you're located.
And we're almost out of time. I just want quickly, when we're looking at this house, idyllic on a lake, on an island, beautiful. Does this also include homes in small towns, like resort towns kind of thing?
Absolutely, yes. And it includes, residential regions within those markets where people are living year round. That's another trend that we've observed in the last couple of years, especially in the post-pandemic era, people who are moving to cottage country and living there full time.
Okay, Annalise, we have to wrap it up there, but thank you very much for joining us.
My pleasure, thanks.
All right, that was Annalise Cugliari-Agalagriti, the Vice President of Research and Communications at Royal LePage. Market Call is coming up next. Joining us today on Market Call, Eric Nuttall, Partner and Senior Portfolio Manager at 9 Point Partners. His focus is energy stocks. And thanks for watching Morning Markets. We'll see you back here tomorrow.